In the last few years, interest rates have been at the forefront of discussion around mortgage affordability in Canada. Whether you're a first time homebuyer, a homeowner in the middle of a renewal, or someone considering refinancing, the rising interest rates have had a significant impact on your ability to afford a home. In 2022 and 2023, the Bank of Canada was aggressive in its approach to tackling inflation. We saw some of the steepest rate hikes in history, pushing borrowing costs higher and higher. At the time, these rates were necessary to curb inflation, but they also made it more expensive for Canadians to borrow money, especially things like a mortgage. But in 2024, things started to shift. By the middle of the year, the Bank of Canada began easing interest rates, holding the policy rate at 2.75%. This move gave some hope to homeowners and prospective buyers who were feeling the weight of the high rates. But here's the thing. Although the rates may have come down slightly, they are still much higher than what we saw in the pandemic era. And this continues to make it harder to afford a home, especially for those who bought or refinanced during the ultra low rate years during the pandemic. Now, you may be thinking, okay, so rates are still high. What does that mean for me? Well, the reality is, despite this easing, borrowing costs are still far above where they were during the pandemic era's lows. This means that affordability continues to strain many of Canadians. The main issue here is that even though rates have eased slightly, the damage has already been done. Many Canadians who took advantage of low rates a few years ago are now facing what we call payment shock when their mortgage is coming up for renewal. And for those who haven't refinanced yet, this situation may feel even worse. But we'll get into that in just a little bit. The challenges are clear: rising interest rates, higher mortgage payments, and greater stress for homeowners. And as we look ahead in 2025, analysts are predicting at least 2 more rate cuts, which could bring relief in the form of lower variable rate mortgages by about 0.5%. But in the grand scheme of things, these cuts may not be enough to truly address the affordability crisis. But here's the catch. While the situation may seem dire, there are ways to manage these rising costs. In fact, you don't have to just sit back and watch as your payments increase. Stay with me, because in just a moment, I'll show you exactly what you can do to take control of your mortgage situation and protect your financial future. Let's dive into what's really happening and how you can navigate through it. So we've seen the rates rise and we've felt the strain. But now we need to dive deeper into what's happening on the ground. The real impact isn't just in the numbers, it's in the real experiences of homeowners who are now facing the fallout of these rate hikes. For many homeowners, the issue isn't just about the higher interest rates. It's the payment shock that comes when they renew their mortgage. If you bought or refinanced during the pandemic, you were likely locking into a much lower rate than what we're seeing now. Many homeowners were enjoying rates as low as 1.5% or 2%, but those days are long gone. Now, those same homeowners are facing rates upwards of 5%, sometimes even higher depending on their credit or type of mortgage. This is what we call payment shock. It's the shock of having to pay significantly more each month to service your mortgage. And if you were budgeting based on those low rates, the higher payments can feel like a financial gut punch. Let's look at an example. Imagine a homeowner who took a $400,000 mortgage at a 2% interest rate. At the time, their monthly payment might have been around $1,600 a month. Fast forward to today, and that same $400,000 mortgage at a 5% might result in monthly payments closer to $2,300 or even $2,400. That's an extra $700 to $800 a month just for the same loan. For families already stretched thin with rising groceries and utility bills, this can be a massive burden. Now, this payment shock isn't just affecting people's budgets. It's also having a real impact on mortgage delinquencies. Delinquencies are when homeowners miss payments, and we've already seen a sharp increase in this area. According to reports in early 2025, the mortgage delinquency rate in Ontario jumped to 71.5% year over year. That's a significant increase, but it's important to note that the actual delinquency rate is still low, around 0.24%. However, this dramatic raise is a red flag. It shows that many homeowners are struggling to adjust to higher rates, even as we move on to 2026. This increase in delinquencies is a clear sign that the pressure of higher payments is becoming too much for some people to handle. And while the overall delinquency rate is still low, the trend is worrying. It shows just how quickly affordability can become an issue when rates rise rapidly. The effect of rising mortgage payments don't just stop with individuals. There are broader economic implications as well. When people are spending more on their mortgage, they have less money to spend on other things. That means less money going into the local economy, less spending at businesses, and potentially a slowdown in the housing market. We're already seeing signs of this. Fewer people are buying homes, and some homeowners are deciding to delay renovations or move to more affordable areas. This could have a ripple effect through the economy, especially in markets like Ontario, where housing is one of the major drivers of economy activity. There's a reason why we're talking about this so early in the year. It's a warning to homeowners who haven't yet faced their mortgage renewal. If you're one of those people who locked into the low rates during the pandemic, your renewal is likely coming up soon, and without careful planning, you could be facing a tough situation when that renewal happens. For many homeowners, this means thinking ahead. You need to start budgeting for the possibility that your payment will go up, and you need to consider what actions you can take to avoid a worst-case scenario of falling behind on your mortgage payments. Now, we know that rate cuts are on the horizon. Analysts are predicting at least 2 more rate cuts in 2025, which could help bring variable rate mortgages down by about 0.5%. This is a positive sign, and it should provide some relief to homeowners who are struggling with high variable rates. But let's make one thing clear. Even with these rate cuts, borrowing costs will remain far above the low levels that we saw during the pandemic. And for homeowners locked into fixed rates, the relief may not be significant. For those who have already experienced payment shock, it may not be enough to turn things around. It's important to recognize that while rate cuts can provide some relief, they won't undo the damage that's already done. The reality is many Canadians are still dealing with higher payments, and it will take some time for rates to come down to a level that truly make homeownership affordable again. So what can homeowners do to prepare for a continued impact of high rates? The first step is understand your options. If you haven't already done so, reach out to your mortgage broker or lender to discuss your renewal options. Secondly, now this is the time to start looking for ways to reduce other costs in your budget. For some, this may mean refinancing to consolidate debt or cutting back on discretionary spending. Others might look into alternative mortgage options such as switching to a lender with a more flexible payment schedule. The key takeaway here is that knowledge is power. The more you understand your mortgage and your options, the better prepared you'll be to handle whatever comes your way. So we've covered the major challenges: payment shock, higher delinquencies, and the economic impact of these rising rates. But what about the solution? What can homeowners and potential buyers do to navigate these difficulties? It may feel overwhelming, but there are steps that you can take to regain control of your financial situation. First and foremost, the key to managing these rising rates is proactive planning. If you haven't already, start preparing for your mortgage renewal months in advance. The more time that you give yourself to explore options, the better equipped that you'll be to handle potential payment hikes. There's no need to wait until the last minute to reach out to your lender or your mortgage broker. If you're currently dealing with a variable rate mortgage, it may be worth considering refinancing to a fixed rate mortgage. While fixed rates are higher than they were in the past, they offer stability and can protect you from further interest rate hikes. And if you're nearing the end of your term, shop around. Some lenders may offer more competitive rates, even in this high interest rate environment. Don't forget that there are government programs designed to help homeowners. If you're struggling with affordability, you might qualify for assistance programs like the First Time Homebuyers Incentive or other provincial relief programs that can ease the burden. Even if you're not a first-time homebuyer, some of these programs may still offer valuable options for easing your monthly payments or supporting refinancing. For some Canadians, consolidating high-interest debt into their mortgage may be a viable option. If you're carrying credit card debt, personal loans at high interest rates, rolling that debt into your mortgage could reduce your monthly obligations and give you some breathing room. However, it's important to carefully consider the long-term impact and ensure you're not just shifting debt around. It's also crucial to stay flexible in your budget. Start by revisiting your spending habits. Look for areas where you can cut back, whether you're dining out less, canceling subscriptions, or reducing discretionary spending. Every little bit helps when your mortgage payments are increasing. Also consider increasing your mortgage payment if you're in a position to do so. This can help reduce your overall mortgage balance and lower the interest that you pay over the long run. Stay informed about the Bank of Canada's policies and upcoming rate decisions. While no one can predict the future with certainty, knowing when rate cuts or hikes are on the horizon can help make you make a better decision about your mortgage strategy. If you can take away one thing from today's video, let it be this. While rising interest rates and mortgage affordability challenges may seem daunting, they don't have to define your financial future. By staying proactive, exploring your options, and adjusting your budget, you can weather the storm and come out on the other side with greater financial stability. If you're feeling unsure about your next steps or need expert advice on navigating mortgage renewals, refinancing, or government programs, I'm here to help. You don't have to face these challenges alone. Book a consultation call with me and let's find a solution for you. If you found this video helpful, make sure you like, share, and subscribe for more mortgage tips and financial advice. And remember, I'm always here to help guide you through the challenging mortgage landscape. Take action and secure your financial future.